Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZHONGYU Energy Holdings Limited annual report. ZHONGYU Energy Holdings Limited is a diversified energy company that provides a wide range of services and products related to natural gas and renewable energy. The company's business operations can be broadly categorized into several key areas. Firstly, the company is involved in the development, construction, and operation of natural gas projects, including the investment, operation, and management of gas pipeline infrastructure. This involves the distribution of piped gas to residential, industrial, and commercial users, as well as the provision of related services such as property management and engineering project budgeting consultancy. In addition to its core business, ZHONGYU Energy Holdings Limited also provides a range of value-added services, including the operation of compressed natural gas and liquefied natural gas vehicle filling stations. The company is also involved in the design and development of new energy technology, including smart energy products and systems. Furthermore, the company trades in various types of energy-related commodities, including natural gas, coal, and liquefied petroleum gas. It also provides a range of equipment and materials related to gas distribution and use, such as stoves, gas cooking appliances, and wall-hung boilers. In terms of its services, ZHONGYU Energy Holdings Limited offers a range of consultancy services, including digital and information technology development, energy project design and consulting, and engineering project budgeting. The company also provides management services for various types of energy-related projects. Overall, ZHONGYU Energy Holdings Limited is a comprehensive energy company that provides a wide range of products and services related to natural gas and renewable energy. Its diversified business operations enable it to cater to the needs of various customers in different sectors of the economy. ZHONGYU Energy Holdings Limited maintains a market capitalization of $7 billion, broadly in line with the industry peer group. ZHONGYU Energy Holdings Limited trades at a higher price-to-earnings ratio of 30 times and a higher price-to-book ratio of 1.01 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count while revenue has grown, but declining assets and equity suggest buybacks may be taking precedence over reinvestment. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the growth side, the company's revenue is driven by various factors. The sales of gas business remains the largest contributor, accounting for 82.9% of turnover. Additionally, the expansion into external markets and incubation of sub-brands of interior have contributed to revenue growth. The adoption of digital and intelligent technologies, such as pipeline network inspection and leakage early warning systems, has also driven growth. Furthermore, the company's diversification efforts through value-added services, including gas insurance and interior beautification services, have contributed to revenue growth. The launch of new business lines, such as biomass expansion and green finance cooperation, has also driven growth. Moreover, the application of artificial intelligence empowerment has enabled the company to optimize its operations and increase revenue. On the decline side, the downturn of the real estate sector has had a significant impact on the company's revenue. Additionally, decreases in revenue from sales of gas and smart energy have contributed to the decline. The sales of gas business experienced a 5.3% year-on-year decrease, while the smart energy business saw a 42.2% year-over-year decrease. The integrated energy business also witnessed a 42.7% year-over-year decrease. The company's revenue has been affected by various factors, including decreases in sales volume of integrated energy and unit of natural gas sold to vehicles. Furthermore, the average selling price of natural gas for industrial, commercial, and wholesale customers decreased, leading to a decline in revenue from sales of gas to industrial customers. The net income of the company underwent significant changes between 2024 and 2025. A notable decrease was observed in the net income from gas pipeline construction, which dropped by 23.5%. However, this decline was offset by a substantial increase in net income from value-added services, which rose by 23.5%. As a result, the overall net income saw a significant surge of 68.9% to $147,278,000. The profit margins also experienced an upward trend during this period. The gross profit margin for gas pipeline construction improved from 69.7% to 75%, while the profit margin for gas pipeline construction increased to 75%. Consequently, the overall profit margins rose from 1.1% in 2024 to 2% in 2025. These changes indicate a shift towards more profitable business operations and improved efficiency in the company's value-added services. The company's financial performance indicates a significant improvement in its ability to generate operating cash flow. The data shows that the company has been able to increase its operating cash flow from $931,119 in 2024 to $351,419 in 2025. This upward trend suggests that the company is becoming more efficient in managing its operations and generating cash from its core business activities. As a result, the company is now generating positive operating cash flow, which is a key indicator of financial health and stability. The company's debt level and interest expenses have undergone significant changes. A notable increase in non-current liabilities of 101% is observed on page 12, indicating a substantial rise in the company's debt obligations. However, on page 23, total borrowings and lease liabilities only increased by 2.3%, suggesting a more moderate growth. Despite this mixed trend, there are indications of potential debt issues, as highlighted by an impairment loss on trade receivables and contract assets on page 35. On the other hand, interest expenses have decreased significantly from $772,978,000 to $397,485,000 on page 18, indicating a reduction in borrowing costs. Furthermore, bank interest income has increased from $4,503,000 to $6,518,000 on page 35, which may offset some of the reduced interest expenses. Overall, while there are signs of potential debt issues, the company's interest expenses have decreased, and its bank interest income has increased, suggesting a more stable financial situation in this regard. The performance of various segments and regions in the industry has been mixed, with some showing significant growth while others have declined. In terms of well-performed segments, value-added services have seen a notable increase of 23.3%, indicating a strong demand for additional services such as maintenance and repair. The CNG/LNG segment has also performed well, with an increase in numbers from 10,734,109 in 2024 to 10,316,759 in 2025. Additionally, gas pipeline construction has shown growth, albeit at a slower rate than expected. On the other hand, some segments have underperformed significantly. The smart energy segment has seen a substantial decrease of 42.2%, indicating a decline in demand for this type of service. Vehicle filling stations have also declined by 20%, suggesting a reduction in fuel consumption or changes in consumer behavior. Furthermore, gas pipeline construction has experienced a decrease of 20.6% in numbers from 2024 to 2025. The company has a history of paying dividends. In 2024, it paid out a total of $54,966,000 as its final dividend. Furthermore, for the year ended 31st December 2025, the company proposed to pay a final dividend of HK3 per ordinary share. This indicates that the company has a consistent practice of distributing profits to its shareholders through dividends. That concludes the financial summary for ZHONGYU Energy Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.